Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to have a discussion on income after loss and some things you should be thinking about, whether it be Social Security or pensions. And I know we've had this month, we talked about
tax planning.
and there's tax planning involved, but I know earlier this month we talked about kind of the 90 days after loss, and then we've also gone over inherited IRAs. So we thought it's important to really kind of look now at kind of the income replacement and some things to be thinking about. And obviously, when there is a loss, we talked about in the past, you don't have to do things right away, take time, but there are some things that do need to get addressed and looked at. Some of them is the income replacement.
And there's some planning you can do as a couple before you lose a spouse that's really important to address. So this is not just for people who've already lost someone, but also some planning ideas for beforehand.
That's a good point. We've actually worked with some clients in the past where we looked at some different scenarios, and there was some differences in ages, and so they wanted to know if something happened to one versus the other, and so we were able to run some different kind of what-if scenarios for them to make sure that we didn't miss anything or if something did happen that wasn't planned. And so you're right, that's definitely something you want to consider.
Because you really do need to look at the big picture, and it's a reality check, because oftentimes if you do lose a loved one, you go from 2 checks to 1 check, and, and what does that look like? And your expenses oftentimes will stay the same.
Yeah, and so you have to then look at, are the Social Security and pensions, and are there any other income sources coming in? And so potentially there could be a big drop in income if you're living off of multiple Social Security checks.
Yeah, and one of the things that is the big shocker I often see is that taxes often go up after you lose a loved one, because, and we'll go a little bit more deeper on that later, but think about it, if you're filing jointly and then all of a sudden you're filing single, you lose a whole tax bracket, but oftentimes you do still have similar income. But let's jump in and kind of talk about Social Security and what happens, because a lot of people think you maybe get to keep both checks, but you don't.
The reality is there is potentially a survivor benefit, and you then have to look at what's the best option. It's not a one-size-fits-all. It's just take the survivor benefit. It's then trying to coordinate.
Do you take the survivor benefit, or do you take your own benefit? And like Catherine just said, it is definitely not a one-size-fits-all, and you need to look at ages of the 2 spouses and what makes most sense, because timing really does matter. Are you taking early versus full retirement age? And your widow benefit, if you're taking the widow benefit or survivor's benefit, that can start as early as age 60. And then there's also remarriage rules. So all of a sudden, if you get remarried, you have to be careful too with those different benefits. So some of the common mistakes that we're seeing are you lose a spouse, and then all of a sudden you file really quickly. You make that knee-jerk reaction because you were like, oh, I need the income. So you file too early because you're fearful without actually considering what all the options are. You really need to check into what both benefit options provide to you and which one makes the more sense for you.
And it is also interesting, though, what we do find is if there are couples, and if one of them waited till age 70 before taking the benefit, and if they passed away, potentially they have a pretty decent survivor benefit. But then once again, you have to kind of coordinate what is your own benefit versus the survivor of it. But a lot of times we do see the survivor benefit being higher. So, but once again, it's looking at both options and seeing and coordinating.
Not everybody's situation is the same. So, and honestly, the Social Security planning is one of the areas where a small timing decision can make a huge, huge difference in the long run. So definitely make sure that you're looking into that, because it's not one size fits all at all.
So let's talk a little bit about pensions. So pensions, usually if there is a survivor, it really depends on when the spouse, when they elected their option, did they do a survivor benefit or did they take the whole benefit themselves?
Like a single life.
So there could be 100% benefit went to the spouse or the decedent, or did they set it up where they only got 80% and 20% goes to the spouse, or is it 50-50, or what are those benefits?
So there are a lot of different elections, and so this is one of the places where you can actually plan ahead of time, and that we could help out with is really, do you want a single life or do you want a joint and survivor option?
And then you have to look at, are there cost of living adjustments or not, because that could change over time, and really looking at if the value of today versus later, what's that impacting your plan? And so I think it's one of those things you don't want to be caught off guard later. I think that's definitely something you want to look at, now if you can.
Exactly. Before a loss, you could ask yourself, okay, what option have I selected or should I select? What percentage continues? And like you said, is there a cost of living adjustment? And or is there life insurance maybe to replace it if the pension stops completely when one of the spouses dies?
And so let's talk a little bit about maybe some of the tax stuff that you potentially see.
the
So you
tax
mentioned earlier, so the year that somebody passes away, then you file, is it still jointly, correct?
Jointly, yeah. And I get that question a lot. So the year that your spouse passes away, you still continue, you can file jointly for that year. The year following that, a lot of people want to know, can I file qualifying widower or not? And that depends on if you have a dependent or not. And so you want to make sure you're knowing, what your filing status can be, because that will help you plan for taxes. Because when you have two incomes for that last year, and then all of a sudden, if you drop down to that single filing status, your bracket shrinks significantly, and it can be a huge, huge shocker. And then oftentimes you may lose, deductions and credits because your income may go down a little bit, but the thresholds for different deductions and credits stays the same. There's often a marriage penalty. And then, so if you drop down into single, you might cross a threshold that you wouldn't have had you still been married. Because you may be still getting the same RMDs or required minimum distribution, so your income may still be higher. But then you may lose some of your tax benefits because all of a sudden now you're single, not married. And then the other thing that oftentimes happens is people don't realize they cross the Medicare IRMAA thresholds, and all of a sudden that's the income-related monthly adjustment amount. So those are basically a penalty that you pay on Medicare premiums if your income goes too high.
And now that then you're going to be single the next year.
Correct,
so that
and so
changes.
the thresholds are even lower, and so it really does to me feel like a potential, like a widow's penalty. So a lot of people say, I feel like I have a lot less income, but now I owe more in taxes, and it's a true thing, and it does come as a surprise. So you definitely want to be planning ahead for that.
And so what we find kind of is that year, the income gap year, where basically you're used to having two checks, maybe one, and kind of looking at what is your income going to be for the year, and especially that first year. There could be some planning opportunities, which you alluded to with the tax part, but in that year that you still filing joint, there could be potentially, if you have a step up in basis, which means that if you own stock or real estate or something together, and then
You could sell it and not pay tax.
Correct.
Yeah.
So there's some things, but once again, there's a big decision. So sometimes it's hard because you have that tax year, but then what kind of decisions are you making in that year?
But the opportunities that present themselves because you do still have that married filing joint bracket is maybe you do some larger IRA withdrawals because you can be at a lower bracket, which then your RMDs later or required minimum distributions will be lower because right now you've got that double tax bracket, so maybe you're taking a little bit more to use lower rates. Or you could do Roth conversions, so you could take money and convert from traditional to Roth. Like you alluded to, capital gains harvesting, but oftentimes you will get that full stepped up basis depending on how your assets are titled when one of the spouses has passed away. And what that means is, let's say you bought a stock for $100 and now it's worth $1,000. If you sold it before your spouse passes, you're going to be paying tax on $900 per share. But if you sell it after the spouse passes away and you inherit it, it would jump up to $1,000. If you turn around and sell it right away, there's zero taxes owed. So that stepped up basis is very valuable. But you want to make sure that you're talking with your advisors and getting some good advice there.
And I guess depending if you are required minimum distribution age, obviously now it's age 73, but that will change down the line to age 75. But in between, or if you're below that age, there might be some, like you said, conversions and planning. Or if you're required minimum distribution age now, then there's the qualified charitable distributions potentially you could take, which means if you wanted to give part of that to charity, and then it's not included on your income. So there's a lot of different techniques in planning. It's just kind of also a matter of what's best for you, and what do you do? What have you done in the past, and what do you want to do going forward?
And it might make sense also. I was just thinking about what you were saying about the married filing joint bracket and having that bigger bracket. repositioning your income for tax efficiency in that year where you have the double bracket might make a lot of sense, because otherwise after that first year, you're going to be single most likely. And so often what we see is widows, they have these very large required minimum distributions, so then you're going to be paying a lot of tax on that. So if you're creating a mix of, your taxable accounts, maybe you have some Roth accounts and some IRAs, it gives you more control over your income for the future. So I definitely think that even though there's a lot of decisions to be made in that first year, that's maybe one of them, is how do I reposition some of the income for tax efficiency for later.
So I know we covered a lot. So obviously we talked about Social Security benefits and survivor benefits, pensions, kind of getting a good idea if there's a survivor benefit or not, because you don't want to get caught off guard later if there
Correct.
isn't.
Yeah.
And looking at income replacement. And then if some income does disappear, do you still have enough to cover your expenses, or is there extra? And then it's kind of also a question of revisiting your lifestyle and your expenses. I mean,
Yes.
what's left and what, how much the things cost for just for one person. And then you talked about maybe being a little more tax efficient with income. And then the other thing that we didn't touch on, which, is another option to consider, is, are there any life insurance needs? And depending on your age and kind of, that's definitely one area where we see potentially there's some life insurance with long-term care benefits and some other planning. So definitely something to consider
before and after a loss.
And it's interesting. We have the conversation a lot is, what are your plans kind of later in life? Like, what do you want to do when you're 80, 90, 95 years old? And everybody's a little different. Some people are like, well, my kids are going to take care of me. Right. And some people say, I'm going to go to a place. Or some people say, I'm going to stay in my home and I'm going to have in-home care. And it's kind of, thinking about that last phase and what do you want? And because everybody's different. It's interesting. It's not, everybody wants different things in their lives, and there's costs associated with that too. Or do you have some benefits that will cover some of those expenses?
It'd be a really big financial blind spot.
Yeah, exactly. So definitely a lot of different things to consider. Like Rachel mentioned earlier, we're happy to help you look at that even before or during or after a loss, and we definitely feel that these are important conversations to have, and they're tough conversations to be thinking about. But at the end of the day, I think we want you to have a life that's fulfilled and make sure you have enough, and we're happy to be a resource. So I know we covered a lot today. I believe we have a checklist as well.
In the show notes.
Yes, so check in the notes. And then if you'd like to contact us, we're happy to have a call with you. You can reach us at 760-692-5700. Once again, that's 760-692-5700. And we want to thank you today for getting savvy with us about your finances. And remember to savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.